This is Rudy for Bester Investor. What's up? Hope you're all doing fine. I hope everything's good. I'm sure for those of you who have been following me, you probably like the little uptick we've seen in OXY over the last couple of days. What I thought we can do today is look at some of my undervalued favorites. I put the favorites in little quotation marks because you should never fall in love with a stock. So I never get to really like it. So I shouldn't be calling it my favorites, but I'm going to show you some of the undervalued stocks I have in my portfolio. So the first one is kind of obvious by now because some of you even call me Mr. Oxy, but I thought I'll just give you a little update here, one slide. This is Morningstar as of September the 8th, so it's about a week old. You can see that Morningstar is basically saying Occidental's fair value estimate is $26 per share. Everybody knows it's undervalued, and we have seen it currently trade back at about $11. Even though just a few days ago it actually dropped below 10 very, very briefly. So anyway, that's Oxy. I'm not going to spend too much time on Oxy because I actually want to talk about the other two. First one is General Electric, and then I'm going to end it out with a little surprise, which is Icahn. So let's take a look and see what these ones are. So General Electric, a quick snapshot here, trading at $6. How the mighty have fallen. I can remember a time when General Electric was kind of static in the sort of $40 range, nice big fat dividend of about 4.5%. And then we look at it today and we say over the last 52 weeks, it's been hovering between $5 and $13. Not dramatically volatile, but still, quite a bit of volatility there. Unlike Oxy, it hasn't crashed completely in terms of market cap. $61 billion value as of today. The PE is a little rich for me. Generally, if I was going to get into a new position, I would look for a PE of below 15 because that's kind of where the S&P average has been. So I want to buy at a little less on a priced forward basis than 17 or 18 PE. But I already have a position in General Electric, so what I'm saying is not really relevant as of today. Much like Oxy, it is richly rewarding its shareholders by offering 4 cents as an annual dividend paid quarterly, so you get a whole penny every quarter as a dividend. However, there's a 60% institutional shareholding in General Electric, which probably provides us with a little bit of confidence. Let's take a look here at the valuation and the profitability of General Electric. This is not a pretty picture. So over here on the left side of my screen, I have valuation, price to earnings. TTM means trailing 12 months. MRQ means most recent quarter. The little gray blob is General Electric, and the little the little black vertical line is the industry average. So if we look over here on the right-hand side, you can see that GE's PE ratio at around 17 is actually less than the industry for conglomerates at 22. Price to sales, price to book looks a little bit horrible for General Electric. What about the profitability analysis? If we go down here at the bottom, gross profit margin trailing 12 months, operating profit margin for the trailing 12 months, the net profit margin, where GE is taking a little bit of stress and strain. Over the past few days, though, it's been looking up for General Electric, and I'll tell you why in a second. So we look at the financial strength here for General Electric. Just yesterday, Larry, the CEO, mentioned that they expect to be cash positive the second half of 2020. So that's really, really good news. The other thing is, and this is really small at the top here, so I'm just going to read it quickly for you. Although it reduced the percentage of debt used in its capital structure, GE has a debt-to-capital ratio of 69.9%, so almost 70%, is one of the most highly leveraged companies in the industrial conglomerates industry. Kind of sounds like Oxy a little bit, doesn't it? So if we look at the total debt to capital ratio, GE is way above its peers. Interestingly enough, the industrial conglomerates on average is almost 60%. So sometimes these things look worse on paper than what they actually are. The change in debt, though, is kind of edging towards General Electric and in favor of General Electric, and especially since they're going to be cash positive in the second half of 2020, things are looking up. How much exactly are they looking up? So once again, I took a quick look at Morningstar. As of September the 4th, they have a fair value estimate on General Electric of $8.47. We pretty much probably all know what the company is all about. There's the market cap of around $60 billion. And then the Morningstar analyst report also shows General Electric as undervalued right now. So it's one of my existing positions, so it's not a position that I would open at this stage, but kind of that's where it's at. It's not a huge uptick here for me from $6 to $8 or whatever. So unlike Occidental, I don't see it going from 11 to 20, which would be a huge uptick. But there is a little bit of growth in the stock price here as well for General Electric. Well, here's the one that's probably a little bit of a surprise to you. Yes, I also have a position in Icahn Enterprises Limited Partners. So Icahn, of course, is the, or IEP, is the ticker symbol for Icahn Enterprises Limited Partnership. I have an existing position in this. It's also undervalued for me, trading sort of at around a $50 range. It's kind of trading in the middle of its 52-week low and high range. Got a market cap of $11 billion. It means it's almost the same size as OXY, which also has a market cap of about $11 billion. How rich is this dividend? It pays $8 per share. So the annual dividend, $8 per share, is almost 16% paid on a quarterly basis. What about the institutional holding here? 93%. Huh? So that's a quick snapshot. So if you're wondering why I'm invested in Icahn Enterprises, you're probably wondering no more. But let's take a look just a little bit deeper. Much like General Electric, the valuation and profitability analysis is not necessarily a pretty picture, and you can see on all three of these metrics, so price to sales, trailing 12 months, price to book, most recent quarter, gross profit margin, Icahn is lagging quite significantly. The operating profit margin way below the industry peers, and the net profit margin as well. Of course, many people will know that Icahn has had some holdings in organizations that have not been performing too well, which includes Occidental, but it also includes things like Chesapeake Energy and Hertz. He's invested in some good stuff and some not so good stuff, but overall, the IEP valuation suits my narrative for an undervalued stock. So let's look at IEPs Snapshot here. So what you have at the top again is a really small little line. So I'm just going to read it very quickly. IEP's debt to capital ratio at 44.29 is in line with the industrial conglomerates industry norm. So as I said a minute ago, GE is also an industrial conglomerate with a debt to capital ratio of almost 70%, and Icahn is at 44. And then right at the bottom here, the company should be able to comfortably repay its debt given its interest coverage ratio of 7.5 times. If you look at the actual little snapshot here, you can see that the total debt to capital ratio over the most recent quarter, 44% versus the industry's average 57.6%. And the change in debt also kind of trending in Icahn's favor, with the change in debt quarter over quarter significantly lower than the industry average. And then, of course, the interest coverage I just mentioned a minute ago, which is 7.5 times, provides a sense of comfort in that they don't have to sell off assets in order to repay their debt. Quick look at Icahn's Morningstar Report here. Again, it's recent. It's from September the 4th. You can see the last close there. It's got a fair value of 57.61, so about 20% above where it's currently trading. It's a 3-star stock, $11 billion company, and it's undervalued according to Morningstar as well. So this is obviously a stock that I am not only invested in, but that I follow closely too. So I thought it'd be interesting to take a look and see what the Morningstar analysts say about Icahn. So in closing, just to wrap it up here, Occidental is obviously a position that I hold, and most of you will know that I've held this position for about a year now. I have a secondary thesis there as well, which is to add small lots on a regular basis to reduce my cost basis. Right now, as of today, with the Oxy price at around $11, $12, I probably go back into my hold mindset, and I'll see what happens. I have no particular reason to lower my cost basis right now. I'm comfortable in the low 20s, which is where I'm at. So I'm comfortable with Oxy just to hold. With General Electric, I'm also in a holding pattern. I don't anticipate adding any more stock of General Electric. I'll just hold it and see what happens. It's one of my speculative buys. It's one of my smaller positions. It's certainly much smaller than my Occidental position. It's about maybe a third or so of my value of my Occidental position. So I'm just going to hold it and see what happens. And with Icahn, I actually have a slightly different investment thesis there. I hold the stock today because I have an existing position, but I actually have scheduled buys. So I take a look at Icahn at the beginning of every month and have been adding to the position, just buying little bits at a time and growing the position over time. Icahn as a position for me right now is about the same size as General Electric. So the difference between the two is for Icahn, I actually, on a calendar basis, look to acquire more stock. With GE, I just hold. And then just as a final closing comment here, 100% of my US-owned equity positions are enrolled in a DRIP. A DRIP is a dividend reinvestment program, which means in a way, I'm actually acquiring more stock all the time, at least on a quarterly basis if the company pays a quarterly dividend. Now, in the case of General Electric and Oxy, that dividend is only 4 cents per year, so it's kind of irrelevant. In the case of Icahn, with its 16% dividend, or $8 per share, every quarter, the number of shares I hold multiplied by $8 just buys me some more Icahn, and then I just put it in the bank, and over time it just becomes free money. And it compounds, so guys, that's my story for today. It's 3 undervalued stocks that you might want to take a look in if you're not invested in them today. I'm sure we're all familiar with where I'm at on Oxy by now. So this is Mr. Oxy signing off on behalf of General Electric, Icahn Enterprises, and Occidental Petroleum. Wishing you all a good day. Keep well. Stay safe. If you like my videos, please subscribe, and I'll see you next time. Bye-bye.